Briefly, I want to show you why your loan payment doesn't go down by the amount you think you should. Why you need to calculate your interests. This is what I want to help you do. Because until you understand the total power of interest, you will never be able to take advantage of this current environment we have of like increasing interest rates. So let's, for example, let's say you have a monthly payment. This is why your loan balances go down so slow. So I need too old to be broke.com. Different businesses. Just want to help you with the credit card, how to create cash from your credit card. So here's the thing about loan payments. Say you have a loan. This is your monthly payment, $300 for your credit card. You have an annual interest of 24.40%, and the balance on your current credit card that can be charged is like that. $11,300 is the balance that they're charging you this annual interest on. So when you calculate your annual interest, it's 24.4%. So you're taking $11,300 times at 0.2440. That gives you $2,757.20 of interest you owe that year, because everything's done on an annual basis. So in a total year, this is the amount of interest that you would pay. So what they do this, they always recalculate it on a yearly basis, on a monthly basis. So then they say, okay, well, this is your annual interest on that amount if you were to keep it that long. And then they divide it by 12, and now the monthly interest you have is $2,229.70. So what does that mean? Now, this is the amount of interest you will pay monthly on this balance amount. That's why you have to always, that's why I asked, do you know how to calculate your interest? Only way to calculate your interest, you can either calculate on a yearly basis, and it's based off, you can calculate this $11,300. This would be the total amount you would pay in a year. Or you can calculate, okay, yeah, 0.24, how much you can pay in a month. So basically, that's saying this is the amount of interest, this is the amount of interest, because they always calculate on an annual basis. This is the amount of interest that you're going to be paying monthly. And once you pay that monthly, $300, so now 300 minus 229 gives you $73. This is the amount that goes to reducing the principal of your loan. $11,300 minus 173 gives you $11,227, your new balance. So when you make a payment, it's not this 300 doesn't automatically reduce that. You've got to consider the interest. Remember, interest is the cost of borrowing money. That's why your balances go down so slow, because you're not paying this amount. Is like mostly interest, and it's maybe $50 or $60. So to get your loan to go down faster, instead of paying this $300, you got to pay like $450, $575. Then you'll get your loan balance to go down lower. So let me know, can you calculate your monthly interest on your payday loan, your monthly payment on your payday loan, your car loans? Are they charging you the proper interest? Let me show you how that works. Subscribe, comment below. Let me know. Put your amounts. Because if you don't know how much you're paying for interest, you will not understand the power of the credit card balance transfer, of how you can create money from debt. Because what happens, convert this to just 2,400.0 something to 1% or zero. Then this money that was going toward interest goes away. So this is zero. So that gives you $2,757 more in your pocket per year if you calculate this amount, which means now you can take this amount and throw $1,000 or $2,000 to reduce this by $2,000. Now you reduce it by $11,300 minus $2,000. I think it's like $9,000 something along those lines. I'm wrong now. That goes down. So if it's 0%, close to 1%, every dollar that you spend every dollar of this payment goes toward reducing your loan payment. And that's how your balance gets reduced faster. Subscribe. Let me know if you want to get more of this.